Are domestic investors booking profits on very critical subset of our market, consumer goods, industrial, and banks?
Well, yes, definitely. We've seen a lot of investors take profit. Like if you even consider where the market is coming from in 2017 when the Investors and Exporters FX window was launched, with the significant gains that have been made, we've seen a lot of investors start to take profit. And this is in line with historical trend in the year leading up to general elections. We know with the elections coming up next year, the general uncertainty around the elections, because we know that the one thing investors do not like is uncertainty. So in a situation where you have elections coming up, you usually see sell-offs in the market, and this is in line with what we've seen play out. And like historically, looking at the market from as far back as 1999, around the summer period, June, July, August, and usually into September as well, you tend to see a lot of sell-offs in the market. Then from October, you start to see investors come back. Then maybe you start to see some profit taking. Then the December period, which is usually termed the December rally, we see a lot of investors come back into the market before exiting again to rebalance portfolios in the January of the next year.
Last week, 2.74% was a major dip.
Definitely.
Last week, that was a lot of pressure. Almost 3% in a week.
Yes, I mean, we had the market down on all trading days. We've had a bearish run of about 6 consecutive days
sessions.
6 consecutive trading sessions. So from the previous week, including the 4 trading days from last week. But looking beyond just the negative performance that we've seen, looking at the individual stocks and the market as a whole, can we say the market is overvalued? Not necessarily. If you look at the fundamentals of the market, compare them to similar markets across Africa, for instance, you can still see that the Nigerian market still remains somewhat undervalued, with a price to earnings of about 10.7, which is significantly lower than the closest market to us is Egypt, which is about 14 times price to earnings. And even on a price to book basis, Nigeria is the only market here in Africa trading below a price to book ratio of 2 times. So it still shows that there's a lot of opportunities there for investors to take advantage of. So regardless of the losses...
But they're scared one way or the other. Investors are scared.
Definitely.
Just say yes. Yes, they're scared one way or the other about... But again, we're not having the first political transition, so this is not necessarily new. So why would investors just be a little bit jittery when it comes to the political risks in this jurisdiction?
Yeah, so it's a trend that we see across markets. It's not just peculiar to Nigeria. It's not just peculiar to Nigeria, because sometimes we're not sure if we're going to have a continuation of the current administration or we're going to have a new administration come in. We're not yet certain on what sort of policies they might be implementing and how these could affect activities in the market. So more often than not, you'd see investors, if they have to invest, they rather play in the fixed income part of the market where there's significantly reduced risk.
If you look at the market, look at the first quarter, you look at the first half of the year, what mirror does that give me for the second half of the year?
Well, in our view, the expectations for the first half of the year were largely a more positive performance for the first half, and then in the second half, as we get closer to the election period, you start to see sell-offs in the market. But what we've noticed is investors have been selling off in this first half of the year, and this negative performance might be sustained into the second half of this negative performance might be sustained into the second half of the year. But closer to the end of the year, we might start to see investors come into the market just to take advantage of attractive valuations. Because if you're looking at individual pricing of stocks in the market, there's still opportunities there for investors to take advantage of. In the banking space, most especially.
What will be the catalyst, therefore? Will it be budget 2018? Will it be this expansionary or spending by the government at the center?
Well, for the budget, the 2018 budget, the impact on the markets is usually a more medium to long term and usually associated with the capital expenditure part of the budget, where we start to see the, especially the industrial goods sector benefit significantly from that. And with the job creation that also comes with increased construction works, then we could also see the consumer goods space benefit from that, because as people are earning more, people are spending more, and this has a feedback impact on earnings of these companies. But our top pick still remains in the banking space, especially the Tier 1 banks, where we've seen that amidst tougher operating environments, they've been able to churn out impressive results, weather the storm, constantly deliver alpha to investors. And looking at current pricing of some of these banks in the market, there are opportunities there for investors to take advantage of.
Technically, we're not doing 42% this year.
Definitely not. We won't see the same
quirky,
sort of rallies.
Just put it out there.
We won't see the same sort of rallies that we had last year, which was expected. Because for last year, we're coming from a situation where investor sentiment had been significantly damaged, and we started to see a huge influx of investors come back into the market, and this propped market performance. But we've seen that sort of level out now, so investors are looking at the fundamentals of these companies and trying to play the markets, ensuring proper timing in terms of entry and exit of the market.
So, what's your top for half year? If that will take us, we're now at neuter, technically speaking. So let's just write that off and say, look, where on a scale of plus or minus, where do you see the all-share index for year end?
Well, at the start of the year, when we released our outlook report, where we had three scenarios, for our bear case scenario, we had a market return of about 7% thereabout. We're currently reviewing our outlook. We still believe there's a chance that the market could still end the year in the green, although we don't believe it will be significantly
not likely double digits.
Most likely not double digit though.
Okay, if we have single digits, we can still have a handshake to that. One of the investment analysts from Afra Investment.